another few percent downward from here, and I think from that point, we've got better risk reward into the end of the year. But that's still assuming that we don't have any further additional tariffs in order for the S&P to rally from there. I think the existing tariffs stay with us through the rest of the year.
There were a lot of people who were talking about some technical levels that were breached yesterday. The S&P fell below 2,800, round number people like to look at. But right. Even below that, during the intraday trading, it fell below 2776, which is the 200-day moving average. Do either of those technical signals concern you?
It's a market of stocks, but so those round numbers we do look at, but we keep in mind that's still a market of individual stocks. But when you do have a macro issue like the trade tariffs that are dominating the market right now, well, then you can look at a higher top-down level. I think the key is that the expectations for S&P earnings growth is going from mid-single-digit to very low single-digit growth in 2019 because of this rising expectation of the existing tariffs being with us through the rest of the year. So I think what you've got going on is that the S&P is adjusting to an earnings number from about 169 to about 165 for this year, and investors thinking, well, is 16.5 a reasonable multiple for now, such that maybe we get to 17.5, 18 in a year.
Does your macro view consider that the Fed will raise rates or cut rates? Do you have either of that baked in?
Our view, and one I still feel comfortable with, and of course we're monitoring this, is that the Fed does not cut rates this year. I'd go one step further, although I don't even want to, kind of really deal with it right this moment. We'll deal with it when we get there. I think the next move out of the Fed is likely to be a hike rather than a cut, but I don't think it comes until the first several months of 2020. And my view on this is that simply the Fed wants to explore what the upper end ranges of the neutral Fed funds rate. They're at neutral for now, but in maybe a year from now, they would be able to go up maybe another quarter of a point. All that said, I don't think the Fed gets to 3% or anything above 3% this cycle, and I'm not surprised at all that the 10-year Treasury yield is where it is and that we've got a completely flat curve. I think it's going to be a very long-lasting cycle, another handful of years.
Before we see a recession.
Before we see a recession, but it'll be slow growth, low inflation, low real interest rates, and a no-term premium.
Hey, Richard, I want to ask you a very specific. Ask your question first.
No,
I have a question
and
for you.
As far as your macro view of the markets, your forecast, does that assume a continually strengthened dollar?
Okay, so the way I think about it,
about the dollar.
So if we have a weaker economic growth, U.S. and worldwide, likely even stronger dollar from here. But I think there's a good case to be made that provided the Fed doesn't about face and cut rates significantly, and one would argue if they really have to cut rates, don't mess around with 25 basis points. If you really have to cut rates, knock them down 50 right away. Assuming something like that doesn't occur, the real interest rate differential in place is enough to keep the dollar strong and maybe grinding up a little bit from here, particularly versus euro.
You know, if they were to cut 50 basis points, I think they'd scare the hell out of people.
Well, they shouldn't do such a thing unless it was clearly needed.
Right.
Richard, somebody on Twitter wrote in a really good question for you. Looking at the
My wife?
No.
Okay,
looking at the quantitative tightening program that the Fed's underway right now with just rolling off the balance sheet. They point out that there are plenty of people who think that has the net effect of being about a 25 basis point increase in rates. Do you think they should continue the quantitative tightening, and what will the impact be?
First of all, if you look at the balance sheet as of last Thursday, you can pull it up off the web. They're at $3.91 trillion. So that pace of paring it back has been slowing. If you look at the liability side of the balance sheet, currency in circulation, bank deposits, including excess reserves, et cetera, you are not able to get the balance sheet down below $3.7 trillion and right around that territory.
So we're almost done anyway.
We're near the end. And then you have to consider also, as mortgage-backed securities roll off, they're all out there pretty long right now, that'll be reinvested in treasuries. Just if you just keep the balance sheet at a certain size before you talk about increasing it. So I think there's been this talk, it's been an equivalent 25 basis point cut, but that's all slowing down right now. So that also adds to the stasis you were talking about, David, in terms of rates being where they are for some time.
$200 billion doesn't matter? Doesn't really tighten things?
I'll give you an example. In the 1 to 5 year space of treasuries, there's $5.4 trillion outstanding.
So no.
So that's around, I mean, it sounds awful to say, it's a rounding error.
Right.
And currency in circulation has still been rising despite the Fed's balance sheet
rises,
shrinkage.
David, like clockwork, 6% a year.
Exactly. And
it's over 1.7 trillion.
the other thing is I've come to think of the U.S. policy rate as essentially the interest rate paid on excess reserves.
Yep.
And to the extent the Fed wants to keep interest rates as high as they are, if there's anything artificial right now about interest rates, it's how high they are. They have to do that through allowing banks to deposit these excess reserves, and that means keeping the balance sheet large.
So you say you're looking for markets to sell off 8% from the highs, which is not far from here. So if we sell off another couple of percent, you'd tell people to buy?
Yes, provided that we don't have further deterioration in the trade conflict. Now, my view is that the tariffs will not be dropped after the G20 meeting, but I don't expect the next round of tariffs on consumer goods to be enacted. And I hope to see that there's some type of mutual understanding, some framework, some timeline where the two parties can say to themselves, we'll work on getting these tariffs down slowly over time, maybe 5-point increments from 25% every 6 months for the next couple of years.